session that you've all been waiting for.
Yes.
Well, clearly, because you're still here. And of course, very important afternoon session too. This one is about monetary policy and is subtitled, What Will the Interest Rate Track Be for the Next 2 years? And my guests will all, no they haven't, I haven't warned them of this, we'll come to a consensus on what we think the interest rates will be in the next 2 years by the time we close the session, I guarantee you. So stick around, you might find something worth bidding against. Look, it's wonderful to have the opportunity to speak on this topic at a time when I think monetary policy has having the greatest impact on the lives of ordinary New Zealanders and those in business than it has at any time since the 1980s. And I stand to be corrected on that, but I think that's about right. We've had such a long period where of benign monetary policy conditions, and no doubt that's had an impact in terms of people being surprised by the impact of monetary policy through this most recent 5 or 6 year period. So, the session is monetary policy. The conference, of course, is a guide to is a briefing to the incoming government. I've changed it slightly for this session. It's a briefing to the incoming government and the arriving governor, who of course will be here with us tomorrow morning. So it's a chance for us to discuss and sort our questions out for the governor before he arrives to present to us at breakfast time tomorrow. We have 3 excellent panellists from Victoria University of Wellington, our former Deputy Reserve Bank Governor, Grant Spencer. We have Bryce Wilkinson from Capital Economics, a very experienced and learned macroeconomist. And down the end, lowering the average age of the 4 of us a little bit, is from the ANZ Bank, Henry Russell. And of course, you'll know that the ANZ became a little bit of an outlier this week on estimates of upcoming interest rate changes. So we will have that discussion with Henry in due course. And I see Don Good rubbing his hands with glee at the thought of having that part of the conversation. So without further ado, we'll get each of the panellists to have just a few minutes setting out their stall. We're going to focus on 3 things, really. The current environment and where we're at now and where we're likely to go next. Lessons learned from the pandemic, because of course the current environment is very much linked to monetary policy during the pandemic. And then governance and accountability, which is probably the bit that particularly applies to the government, is what should they do, if anything, to change the relationship that the New Zealand RB and central banks generally should have with their mandates. So that's the topic of conversations. So I'm going to invite Grant to come up and give us a few minutes first, and then the other 2, and then we'll have questions. Cheers. Grant.
Thank you, Stephen. Good afternoon, everyone. It's a pleasure to be here, and thanks to Waikato for inviting me here today. To start with a few facts, inflation has been significantly outside the government's target band now for 11 quarters, nearly 3 years, and it's not expected to come back into the target till later this year. So in light of this serious non-performance, what should the new government be doing with regard to monetary policy and the bank? Well, the first thing they've done is amend the Act to return from the dual mandate to a single price stability mandate. I think this is a sensible thing to do, and in my view, this is more than just a symbolic change. I think that move will actually change, albeit subtly, the balance of risks around decisions going forward. What else should they do? Some people have been calling for an independent review of monetary policy, and that may be appropriate at some point, However, I would wait for the internal review to sort of run its course. So that the bank put out an internal review document in late 22, and they came to some conclusions there, but they also set out a work program with 9 points for areas for improvement and for learning. Things such as, improving data, improving the forecasts, understanding better the interaction between monetary policy and supply shocks, and also the interaction with fiscal policy. These are very important areas and very important lessons from this period, the post-COVID period. So I think it's important to wait and see what the bank comes up with. I think it's taken quite a long time to do that. And I'll be interested to see if Adrian, has comments on progress on this work program tomorrow morning. The other area I think where the Minister should take a look is at some aspects of governance of the bank, especially with respect to funding and with respect to the external membership of the important governing bodies, the board and the Monetary Policy Committee. On the funding side, I think there's something wrong with the process which has allowed operational expenditure to increase by 130% over the past 6 years, and for employment to double over the same period. The board and the Treasury is the monitoring agency, are meant to play a role here, but to me they've been rather ineffective in providing financial discipline to the bank. The other area of external membership of the board and MPC, I think it's important to lift the contribution of those external members to increase their capability so that they can genuinely challenge the decisions of senior management. And recent reviews, both by the RBA and by the Bank of England, have highlighted this point about developing more of a challenge culture from the external members of the governing bodies. And I think that adding to that would be a requirement that, at least for the MPC members, they have more of a voice, that they occasionally are required to put their head above the parapet. So those are some initial thoughts, and happy to comment further during questions. Thanks.
Thank you very much, Grant. Bryce.
Thank you.
You're on.
Thank you, Stephen, and thanks to the organisers for putting on this forum and giving us the opportunity to discuss this. I want to start with a global sort of picture, because what our central bank was doing was much the same as what other central banks were doing at the time, and we need to see the reasons for that and thinking about what's caused what's happened, which is, in New Zealand, is pretty horrendous, I think. I just could hardly believe the discussions before the lockdowns about modern monetary theory as if you can print money and don't have to raise taxes anymore, which wasn't in the Reserve Bank, it was in the community and in the international debate. Modern monetary theory was getting things. And then the lockdown, and here you had GDP sort of plummeting, tourism stopped, and share prices hitting record highs, and then housing prices taking off, and that was obviously a pathology. And then you had the Reserve Bank sort of buying the best part of 50% of the government stock market and paying prices for far too much, and ended up costing taxpayers about $12 billion for no demonstrable benefits that I can see. And then where was Treasury, and where was the Minister of Finance, and where was Parliament? There was no estimate of what the loss was going to be for that, so it just whooshed through. So where it starts, I think, and as it so often does, New Zealand's just an open economy. What happens in world financial markets, we have to roll with. We're like a twig on the ocean wave. And the current malaise, I think, started in the US under moral hazard, underwriting financial markets. And the Greenspan, when he was head of the Federal Reserve, he kept easing up on monetary policy when financial markets were looking a bit weak. And that became known as the Greenspan put. People could buy shares and bonds and stuff knowing that if prices weakened, that the Federal Reserve would probably put it right. Then you had the US government sort of getting and persuading banks to lend to people who had no money and no assets and no ability to repay. And the two big giants, semi-government-owned giants, Ginnie Mae and Fannie Mac, are funding about half the US mortgage market. And then those derivative products developed from that and went around the world. And so we had the global financial crash, which really had me sitting on the edge of my seat. This sounded a bit like the Great Depression potentially unfolding again. So that was a great disaster. And essentially what happened there is that it was a banking crisis which governments bailed out, and they turned it into a government debt crisis, which we've still got. US public debt is about the same as the percentage of GDP in World War II, at the end of World War II, but this is peacetime. And in 2021, the initiative published a report by myself and Leonard Hong on walking the path to the next global financial crisis, because we could see that interest rates would have to go up, and then interest payments on public debt would start to take an increasing proportion of tax revenues. In the worst cases, it can get up to about 20% of taxes. And Italy was looking like a candidate, still is looking very weak, but the US is very weak too. And then, the lockdowns happened, inflation took out, and in 2022, Graham Wheeler, the previous governor of the Reserve Bank here, and myself did a paper on the lessons. It was globally focused at the major central banks on what had gone wrong and a bit about what needed to be done. And the pretty key message there was Ubri. There were issues of dual mandates, which the US has and we had at the time, but essentially, the one thing you can be confident monetary policy can do is affect inflation in the medium term. It can alter the real economy in the short term, but it's hard to predict how it does it. And Milton Friedman famously said, the lags are long and variable. And I think central banks, we're thinking of the Bank of England, the European Central Bank, the Federal Reserve, Reserve Bank of Australia. They became too confident that they could really ease back on monetary policy and be smart enough to tighten up and not let inflation break out. And the economics just isn't good enough for that. A key thing, I think, is they failed to forecast inflation. Not just them, financial markets failed to forecast inflation was going to break out. So did the macroeconomists generally, who are in that business. So but central banks are paid to get it right. So they shouldn't let themselves off the hook. And even when inflation was breaking out, they were predicting it would be temporary. So they each 6 months they'd come out with a higher curve for inflation, and then they'd pull it right down within their 2-year horizon. So a big question for me, for our Reserve Bank, for example, is just what resources are they putting into trying to find out how they can forecast inflation better and not put the country through all that again. And I gather now, I've heard on the grapevine that they are hiring someone to do that. So I'm much more comforted to hear that. It's not going to be easy. I think every one of the major central banks should be doing that, and probably are. And we're probably going to learn more from them. But that's the backdrop to it, and it's the inflation forecasts, which to me were what world markets got wrong, and that Ubri was part of it. Monetary policies is a hard thing to fine-tune the real economy with, because so much depends on perceptions, how people react. Are they going to decide the Reserve Bank was too soft or too hard? If it goes in hard, they're going to be thinking, does it really mean it? Will it back off when unemployment starts to rise? And those things are very situation dependent. So it's not easy. Thank you.
Thanks very much, Bryce. And now, a representative from the bank,
ANZ
Henry.
Bank, that is. Thanks, Stephen, and thanks to the university for having me. And sorry in advance, because I don't think this is going to be good news that you're hoping to hear, but yes, ANZ is calling for 2 additional hikes to the OCR. I think our team is probably the only economics team in the developed world calling for additional hikes at the moment, but I'm happy to take you through our rationale for that. But firstly, it's important to acknowledge that the weakness we've seen in the economy, and that's been a lot of the criticism, I guess, without call, is that why would the Reserve Bank be hiking when the economy is 3%, or economic GDP per capita is down 3% year on year in September quarter last year. That's as severe a slowdown as we saw during the GFC. And look, we're not looking at the upcoming decision as a clean slate. And if you think back to, we're looking at it in the context of what the Reserve Bank said back in November. And the Monetary Policy Committee said that they had little tolerance for any data surprises that would suggest suggest a delay in the return of inflation to target. And that's exactly what they've had over the summer months. I mean, firstly, on the inflation front, domestic-driven component of inflation surprised both the Reserve Bank and us on the upside. The labour market starting point is a lot stronger. The labour market continues to present a picture of relative resilience currently. And so when we think back to the communications there, and indeed the Reserve Bank's projections back in November, they signalled that in their OCR track they had 19 points, essentially just off one hike priced in. And so when we think about the aggregate of those data surprises over the summer months, we think that they actually imply some additional points onto the OCR track. But the challenge for the Reserve Bank is there's not that much room left before they're actually before they have a full hike in their projection. And so the committee is somewhat constrained in terms of delivering, in terms of projecting a hike and not delivering one, particularly given that has been the case for the last 2 MPSs in some respects. And so there's certainly a risk that if the Reserve Bank doesn't deliver a hike, the market will take that as that's the end of the tightening cycle. I think the second point as well is, so how economists tend to think about essentially the condition for sustainable core disinflation is that we need to see spare capacity emerge across the economy. And that's not absolutely clear in the data currently. And in fact, in recent months, we've actually seen a tick up in activity indicators that would suggest that the economy is stabilised and potentially even rebounding before that spare capacity has emerged. And look, monetary policy is about risk management at the end of the day. There's bound to be unforeseen shocks on the horizon, and when we think about the Reserve Bank's assessment in the coming weeks and whether or not there is spare capacity across the economy, we think they'll be pretty cautious, and the evidence is not clear enough to suggest that. Now, if there was spare capacity, that could mean that the preferred approach would be to leave the OCR unchanged and potentially hold for a little longer than they have. But given the Reserve Bank signalled intolerance for any delays, we think that they will hike. I'll probably pause there and over to you, Stephen. Thanks.
Thank you very much. An unpopular position, but well argued. Keep your questions coming through on the Slido, folks. We've got a few here. As I said, we're going to try and split it roughly into where we're at now, then go back to lessons learned, and then talk a bit more about governance. And I suppose Henry's comments certainly put us in the here and now. Gentlemen, I wanted to ask a question to start with And I'm a bit of a monetary policy hawk generally, but just in the last few weeks talking to a bunch of firms around the country, it feels like the interest rates are really taking a toll. And a sense that perhaps, just like central banks were slow to go up, that because of these long and variable lags that Milton Friedman used to speak to, they might also be slow to spot the turn in the economy. And I note particularly the New Zealand interest rate hikes have come in sort of March 2022 through to June, July 2023. So the last one was about just over 6 months ago. I think as a general rule, wasn't it, that monetary policy takes 12 to 18 months to work through? And then everybody's looking at employment, but employment lags again, normally, compared to the rest of the indicators. So just from the panel's perspective, what's the risk that the banks just muck it up the other way now? Grant?
Well, I think that definitely is a risk, that the momentum of the tightening cycle as it plays through the economy actually has us already turning down, so you have to be very careful not to reinforce that unnecessarily if you're already making progress with inflation on the downward track. So I think the bank told us the other day that something like 80% of those OCR increases are now sort of embedded in mortgage rates, but there's still more to go, still another 20%. So there's still more pressure to come from the settings that they have already. My other thought in terms of thinking about whether the bank, I have no inside information obviously, but I would look at from the November MPS, the news that's come through, sure there's been the strong labour market report, but there's also been some good news in terms of progress, like the actual December CPI outcome was lower than the bank had built into their November MPS. Just the other day, inflation expectations has come down, quite substantially. So that's another piece of good news. And of course, they had that the GDP number for Q3, which was showing quite a depressed picture for GDP, even though that was the latter part of last year. So all I'm saying is, if you look at the November position and the sort of net of news that's come through then, plus the fact you've got some still in-store tightening from existing settings, I would not expect the bank to hike any further. I'd expect the bank to sit at their current setting and wait for more evidence that progress is being made on lowering inflation.
Thank you. Bryce, you know this history pretty well. Have we ever had a sharper tightening cycle than what we've had in the last 12 or 18 months?
No, I don't think so, but we hadn't had such a good losing one before then, so
Yes.
so the volatility's been greater.
It's been like a whiplash, really,
Grant
hasn't it?
might know better than me, but yeah. On the answer to the question, I'm like you, I'm normally a hawk. I can give two arguments for and two against, really. The arguments against easing or any drift to complacency are, I think, one is that house prices are going up again. The other one is, in the last week, I think it was, I read an article in The Economist which was citing someone's extensive historical research of episodes around the world in the last 30 or 40 years where central banks have had to tighten to reduce inflation. And what that history apparently showed was that there's a consistent bias, a strong bias to easing too early and then finding they have to tighten up again. And it's easy to see the pressure on them because the whole community hates to see the interest rates going up. They're hurting and the economy's turning down. So there's strong sort of pressure on the bank to do that. On the opposite side of the equation, for a long time there's been, and this is quite a long conversation, let me be short, there's a thing called the US Taylor's Rule, which is an indication of where interest rates would need to be given the level of excess activity in the economy and the inflation rate, to get the inflation rate down. And our OCR has been way below that indicative figure until recently. If you look on a web page called GDP Live, you'll see that there's an estimate of the Taylor-Rule thing, and as of yesterday, it was 6.1%, and the OCR is 5.5, and that's the smallest the gap's been. So on that basis, which is a very hairy basis, you know, policy is certainly within the standard error of the accuracy of this thing about there. The other thing is there are a couple of global economists who I respect who are arguing that central banks stop looking at the money supply growth, and it doesn't make sense to economists just to look at price, say the interest rate, not really the price. CPI is really the price, the interest rate, and not look at what's happening to the quantity of credit going on. And our money supply growth was about 12%, I think, at its peak in about 2021. It's now running M3 at about 3.3% in the last calendar year. So on that basis, that's looking like a really big correction's taking place, and it's, you know, it's hard to find causes with alarm with what's happening to monetary policy growth.
Okay, so Henry, you've heard the other panellists. ANZ rushing off to revise their prediction?
No, look, I would say, I mean, there is certainly a risk that hiking would be a policy mistake, and there has been progress over this in recent time, but it's really the pace of progress that concerns us, and we think which will concern the Reserve Bank. Picking up on what Grant mentioned about inflation expectations, for example. Yes, inflation expectations declined they took a meaningful step down across all time horizons, but if you look at the one-year measure, the Reserve Bank's own forecast for 1 year ahead has inflation at 2.5%. Our own forecast is 2.3%. The inflation expectations are at 3.1% at that horizon. They're not back within the Reserve Bank's target band. That's likely to be a concern. The same applies at the 2-year horizon as well. And if you think about the progress on the inflation front as well, what we've seen is the Reserve Bank's received a very healthy dividend from the global disinflation story. But the challenge with that is it's not necessarily an enduring form of disinflation. And for example, this week we saw data on from Stats' new monthly price indexes, and that was a lot weaker than we expected, but almost all of that was due to sharp falls in airfares. Supply capacity for seats on airlines into and out of New Zealand is obviously recovering from the pandemic, but airfares are not going to fall forever. There is certainly a risk that this normalisation in global supply and the disinflation we're seeing on the tradable side of the basket washes through and exposes a still sticky domestic inflation. And we really have not seen enough. We have seen progress, but it just has not been fast enough. And in fact, on our forecast, we expect in the upcoming Q1 release that non-tradables inflation will again surprise the Reserve Bank on the upside. So even if you are seeing weakness in economic activity, the Reserve Bank does not have a growth target. They have an inflation target, and they need to return inflation to the 2% target in the medium term. And on balance at the moment, it looks like that may not be achieved. There's certainly other pieces of data in our business outlook survey, for example, that showed pricing intentions they've stopped declining and they've normalised, which would imply that there's certainly a risk that inflation normalises above target. So we're certainly not discounting the progress that we've seen, but really it's about when we look at the medium term, which is the Reserve Bank's target, can we be sure that disinflation's going to be enduring?
Okay. There you go. You pays your money and you takes your choice in terms of what you think.
That's the market.
In terms of, one thing I did want to touch on before we move more to the lessons is what's happening in China currently. We often look to the US Federal Reserve because we have a kinship, I suppose, in the Western world with the US Federal Reserve and with the Australian Central Bank. But there's some things going on in China currently which probably, or perhaps we're not taking enough cognizance of, which is the emerging deflation and the trouble they're having getting their economy going again. What impact does that potentially have on New Zealand's inflation outlook, if anything? And is it helpful in a purely selfish way, or actually does it cause us problems?
Well, I think it probably is helpful because weak demand in China is, all commodity prices are pretty weak at present. That's contributing to this overall weakness in traded goods prices, which is the good part. Inflation in New Zealand, the traded goods inflation is coming down a lot faster than the domestic, non-traded inflation. So contributing to that, obviously, is the tightening of monetary policy globally across all central banks, but also the fact that China is, very weak and demand has not been recovering in the post-COVID period. So I would say that's definitely contributing to, lower commodity prices, and it's taking pressure off traded goods prices, contributing to that disinflation that we're seeing globally.
Okay. Anybody else want to add anything to that?
I'd just say a pure view is with a floating exchange rate, we don't have to buy anyone else's inflation rates. we choose our own.
Just then looking back to the last few years, why did, there's a question for you from the Slido, why did our central bank, but actually most central banks, fail to pick the challenge with inflation? And one of you said yourselves that the expectation was that it was transitory. They really thought that they were on top of the situation, and it feels like groupthink. But then you've got some very bright people in these organisations with some very strong capabilities. How did it happen?
I might just jump in. Sorry, Grant.
No, there you go.
I think, firstly, hindsight is a wonderful thing. And if you think back to the context in 2020, across not only the Reserve Bank but central banks globally, it did look as though economies were on the brink of collapse at the onset of the pandemic, and it was economists like ourselves, we misdiagnosed the nature of the shock. We thought it was going to be a negative demand shock, and the appropriate monetary policy response, and fiscal policy for that matter as well, was to inject stimulus into the economy. But obviously that turned out not to be true. It was a significant negative supply shock, and so that is probably the key reason that we have high inflation today, is one, that misdiagnosis to begin with, but two, that stimulus measures persisted for far too long in the early stages of the pandemic. But look, in hindsight is a wonderful thing.
You say hindsight, but I had Grant Spencer on this panel 2 years ago, and there were three of us actually, including your boss, Sharon, was part of the team, four of us. And I think three of us at that stage agreed that the central bank had done the right thing to start with, but we're getting worried about the supply side effects and the failure to notice that actually they were dealing with a different problem to the problem that they thought they were dealing with. And I think everybody was at the, you close an economy down, everybody goes, oh my God, what are we doing? We have to supply stimulus. I don't think there were too many people against that at the start, but there was certainly a change, wasn't there, Grant, in terms of, and were central banks, did they fail to respond?
Well, I think it was early 21, even late 2020, the signs were coming through that the very easy monetary policy combined with the adverse supply shock was starting to see inflation pressures come through. Then, as you say, people said, oh, it's transitory, and so there was this wait. By early 21, I think it was pretty clear that monetary policy should be brought back towards neutral, as opposed to having the foot, flat on the gas still at that point. So, the bank's own internal review came to the conclusion that monetary policy, rather than starting to tighten in late 21, should have tightened early 21. Okay, and I would agree with that. So with hindsight, that's sensible. The bank says, okay, we should have tightened a bit earlier, but really, we still would have had an inflation problem. So to me, it pushes back in terms of thinking about lessons. Was the earlier easing was just too extreme for the situation that we had. And to me, this is the important lesson that we need to sort of figure out. When you have a big adverse supply shock, so capacity is diminishing, is there any point really in putting your foot on the gas with monetary policy, expanding demand at the time when supply is shrinking? At the same time, of course, this was a COVID shock. We had a huge fiscal response. And the fiscal response is what did the work. The fiscal response is what kept the economy going, what kept people employed. What additional benefit was that very easy monetary policy? Other than, pushing house prices up, did it actually achieve anything? I question that, and that's what I think the key question is for the bank and its internal review, is to think, this is not a blame game. This is about, if you had a similar situation down the track, would you respond differently? And I think you should. You should think very hard about a very extreme easing when you've got an adverse supply shock, if fiscal policy is actually, in the driving seat and doing the work. Does it really need to be all hands to the pump? I think the ex post sort of conclusion is that it wasn't the appropriate response.
Let's expand on that a little, Bryce. One of the things that you talked about when we were discussing this panel earlier in the week was the unconventional monetary policies that accompanied the interest rate declines. In fact, I think both of you particularly brought that out. Where are we at with unconventional policy tools now? Should we be thinking that it's a real, because it feels to me that twice in the last 12 or 15 years we've seen banks doing quantitative easing. It feels like it's almost become part of the standard monetary policy toolbox, and yet it's like the break. It used to be like the break glass, real emergency thing. Where are we going with all of that?
Well, the Reserve Bank, to its credit, did publish a review by external people assessing lessons from COVID and the response. And that review surprised me by saying, well, this quantitative easing, this QE, was successful and should be part of a future package. And I just couldn't see that that case had been made at all convincingly. Another ex-Reserve Bank guy, Mike Riddell, is quite convinced that it has virtually no discernible effect. I'm not there. I haven't seen the evidence for that to form a view myself. In my reading of the literature, what's a very important element is what interest rate the Reserve Bank is paying on all the banking system's reserves, which are building up at the Reserve Bank under an aggressive QE policy, which is what we had, massive expansion in the Reserve Bank's balance sheet. And the higher that interest rate, then the more the money can just sit there because the banks are happy. They don't have to lend it out. They're getting an adequate return on it sitting there. So that's an element of it too. And it's an element, to give the Reserve Bank credit, that in those documents they recognised that argument that with the technical terms in the US are floor and corridor systems were played, but we won't go into them now. But the Federal Reserve's also changed in the last decade its interest rate policy on the banking system's reserves held at the various Federal Reserve banks. So there is quite a literature on this. So yeah, I'm not at all convinced that QE had a useful effect.
Sorry?
Can I comment on that?
Yeah, sure.
I mean, I think the bank's internal review said, well, sort of, a cautious sort of tick, but really quantitative easing or the LSAP program was most useful for countering market disruption that happened in the bond market around April 2020. And I agree with that. But the ongoing use of the LSAP was very questionable in terms of any additional benefit it got. In the meantime, it caused distortions and was very costly. So, you know, there's a sort of a cautious acceptance in the internal review. I'd say one of the external reviewers, Mr. Shembri from the Bank of Canada, was quite sceptical about the additional monetary policy instruments. And he thought there was really a need for a more thorough analysis of that. And he questioned, you know, really put some question marks on the bank's own internal conclusions. I would just say that of the various instruments, you could keep them on the shelf. Negative OCR, I would take off the table. I think negative OCR is a very distortionary, totally confusing, and adds very little benefit. The bank never did that, of course, but it was threatening to.
Yeah.
It was talking about it, and it now has it in its toolbox. Well, I would drop that part of the toolbox.
Well, just one thing I'd add as well on those alternative monetary policy. Just going on, picking up from Grant's point, and it was certainly effective at restoring market function. But moving aside from the LSAP program, one of the other measures the Reserve Bank implemented was the funding for lending program.
Yes.
And that, to me, was, I didn't see the justification for that. I think, one, there was no funding crisis in New Zealand at the time. There were bouts of a liquidity crisis, and the LSAP program was effective at restoring, improving liquidity in the market. But the funding for lending program was implemented at a time where we had passed the worst of the COVID period, and it was based on the Reserve Bank's economic projections and inflation projections, which turned out to be to not come true. Obviously, the economy performed much stronger than expected, and in their defence, and forecasting is challenging at the best of times, but in that context, it was incredibly challenging. But I mean, that program itself, I think, is one that it was. I think these tools can be effective in certain situations, but they were implemented in a way that was not, and it was essentially foot on the gas type situation where everything was put out on the table when it was probably not necessary by that point.
Is there any, because you gentlemen have all read the reviews and so on, is there any sense that central banks really understand the impact that they've had on people's lives with some of these decisions? Because I see a disconnect when you have, you know, it was called, you know, famously a least regrets policy to do all this stuff. And there was a sense we were throwing everything at the wall, which at the initial stages was understandable. And we were encouraging people to lend more money, to borrow more money, sorry, and telling people to get out there, buy houses, borrow money. And now a lot of people are high and dry. Businesses are high and dry. So these are real people with massive interest rate bills. And I worry when I read the tenor of some of these reviews that there's a lack of acknowledgement of the impact. Even if it was unforeseeable, there's a lack of, I suppose, empathy for some of the people that did exactly what they were told and have now been caught the other way. Do you folk have any thoughts on that?
Yeah, I think that's right. Central banks have lost status, I think, with this. Yeah, it's a blow to their credibility.
Yeah. The point that, you know, the bank's objective, two key objectives are price stability and financial stability. And when it comes to financial stability, it's about the soundness of the banking system. That's what they're there to protect. They're not actually there to protect the soundness of households and of businesses, or to minimise the uncertainties and volatility in markets facing them. But you're exactly right. You know, for example, with the housing market, house prices went up 50% over 2 years, and then came down the other side of the roller coaster. The bank thinks about that in terms of what's that doing for price stability? Is that giving, in terms of the machine tweaking the dials to influence aggregate demand? And is it covered in terms of the prudential risk to the banking system? It's not actually in their brief to look at the impact on the household and business sectors in terms of volatility, disruption. And, I think there is more of a role for that to, for them to take that into account.
Okay. One thing I would say is that the Reserve Bank cannot control the decisions that households may make. I mean, it's slightly different in the Australian context. If you remember Governor Lowe's remarks, the forward guidance that was given, which was clearly a mistake, and that's a risk. I mean, we didn't necessarily see that to the extent in New Zealand, but in terms of they've lost empathy. As Grant said, I mean, the Reserve Bank has two objectives, and monetary policy tools are fairly blunt, and fiscal policy has a role in kind of smoothing through, or in terms of the distributional impacts of that, but it's not necessarily the Reserve Bank's responsibility.
Understood. Let's talk, though, a little bit more about preserving the independence of central banks, because I'm a great believer in an independent central bank. I think, it's an innovation that New Zealand helped lead the world on, and one of the ones that really worked. But there is a sense, perhaps, both with these unconventional monetary policy tools, but also in the sort of changing interests of central banking, things like climate change and other parts of the economy, that they're being drawn into areas that perhaps are more political. And even something like debt-to-income ratios, which you could argue at one level is the right thing to do from a monetary policy and stability level, but you're also getting into some pretty granular impacts on individual people in society. Is there a danger, and I'm not picking on the RBNZ because I don't think it's unique to them, is there a danger that you get into a situation where you've been successful with one tool or one objective, and people start thinking, oh, well, you could do all these other things as well, and protect the world from itself? And does that actually undermine the mandate ultimately?
I think it potentially does, and in some countries when central bank independence was becoming the norm, some countries separated out the prudential function. That happened in Australia, it happened in the UK. Gordon Brown took out prudential and says, I'm going to make you independent on monetary policy so you can't have all this other stuff to control. So there's an element of truth in that. And when it comes to our own central bank, it does not have the same degree of independence on prudential policy and, for example, macro-pru, as it does on monetary policy. So with the debt-to-income ratios, for example, it can't just decide to go and do it. It has to consult and talk to government, get the approval of the minister. So, I mean, I'm sure the bank will acknowledge does not have the same degree of independence for some of those other functions as it does for the monetary policy independence. But the other element that has come in and be an area of criticism has been the use of quantitative easing and credit easing. Credit easing being when the central bank is buying private sector securities, not just government securities, then it's effectively making fiscal type decisions as which security to buy at which price, etc. And it starts blurring that division between monetary policy and fiscal policy, and which becomes an issue for independence, as you say. Okay. So when that becomes an issue, make sure you stick to your knitting and be very careful if you start dabbling, getting into some of the other areas.
Bryce, what are your thoughts on that?
Yeah, exactly what you say, the mission creep. If an organisation seemed to be successful in one area, load more onto it. I think Pharmac's a victim of that, was putting medical devices into it. I think to a degree the Public Finance Act's is experiencing a bit of that. The fiscal responsibility stuff was put into it, and it was effective, but now people are adding other stuff. On our Reserve Bank, I think I'm on record with that paper with Graham Wheeler. We said one of the problems we thought we identified amongst central banks is the distractions from getting into areas which aren't central to monetary policy inflation or to systemic risk of a banking sector breakdown. And so, obviously the climate change and indigenous issues in the case of our Reserve Bank. But also, I think it gives it a conflict of interest to make it responsible for regulating the whole swathe of smaller financial organisations like insurance companies, credit unions, finance companies and all that. If they go bust, it doesn't affect the stability of the banking system. But if you have a central bank regulating them, if one of them goes bust, the depositors there will say, hey, the regulator wasn't doing its job. It said that if it does everything right, then it's sound, but it's done everything right, and here I've lost my money. And that starts to undermine the bank's goal of an efficient financial system where you should see competitors come in, fail if they're unsuccessful, be successful, and the incumbents sort of suffer. So I'm a bit sympathetic, and I'm on record as saying this, of having something like what the Australians have done, a separate financial authority, which is doing the regulation of individual financial institutions. And so our central bank definitely isn't to blame if a credit union or insurance company goes under.
So it sounds like both of you, and I'm not sure whether Henry will want to comment on this or not, given that he's regulated by the Reserve Bank, but for the two of you anyway, you'd probably favour breaking out the prudential responsibilities of the Reserve Bank from the Reserve Bank.
I personally wouldn't.
You wouldn't?
No, because, I mean, to me, in a small country like New Zealand, this is a valid criticism, but there are arguments on the other side as well. In particular, when you have a crisis, as in the GFC, there's a lot of synergy between the monetary policy and the liquidity management people, the money market people, and the prudential people. And in terms of managing our response to the GFC, I think it was really valuable to have those two functions in the same building. So also with a small country, you can have a critical mass for an organisation, you have mixed skills being moved around. My own view is they should stay together despite this issue.
Right.
I'll just say one thing on one potential benefit, not that I don't have a firm view either way, but if you think back to when the LVRs were eased last year, that was at a time where the Reserve Bank was still hiking, I believe, and it would have made the communications a bit clearer that, some easing of LVRs at a time that monetary policy was still tightening. It kind of blurred the communication a bit in that circumstance, and so macro-prudential policies and monetary policy, they're very separate things, but when they're under the same house, there are risks that they can be confused, I would say.
Okay. We're getting into that sort of governance and responsibilities area. There's been a few comments and there's a few questions here about the importance of strengthening the external membership of the Monetary Policy Committee, potentially also the board. And that's an interesting role, of course, the board versus the MPC. Internationally, of course, the Fed Reserve has much more transparency in terms of the members of their committees talking their book effectively between meetings. What do you think, advising the new minister, do you think should be done to strengthen that role to the advantage, to improve the results of the Reserve Bank?
Well, just briefly, I'll just reinforce what I said in my initial comments, which was, I think there's a strong case to increase the capability to try and engender a challenge culture. And I think it would be reinforced. And in fact, I think there's a recommendation in the recent RBA review is that they're proposing, rather than the board being, their policy board being made of sort of captains of industry, they'd be shifting to more people with expertise, experience, etc., in monetary policy, macroeconomics, that one of their recommendations is that, like, those members should at least be required to come and give a speech or, you know, have a voice at least once a year. I think that was one of the recommendations. So something like that, well, I think would help to reinforce that approach, rather than them just being, you know, buried in the machinery somewhere.
Okay. Bryce?
Yeah, I think we've lost something in accountability. Remember when Don Bryce was the first governor under the Reserve Bank Act, and he had to get inflation down, and it was very high because of the the breakout from the wage and price freeze and all that. And I think he missed the 2% target, which he had to try and get. And I think he had to write a letter of explanation to the Minister of Finance, I think.
He did.
Well, we don't have that at the moment. And I quite like the system which has been changed now, where it was the governor who was clearly accountable for the inflation target. Now we've got a monetary policy committee and external people on, and a lot of secrecy really about what's been debated and what's said there. I think that's weakened accountability a bit. I don't know if it's improved. I've got no reason to think it's improved the quality of the advice the governor gets, because the governor before this change was obviously consulting colleagues and leading a team, and would have to try and bring his colleagues with him rather than get himself isolated or herself isolated. I think, yeah, the move to the single mandate, again, I fully support for accountability reasons. But the other thing is the role of the board and to what degrees it's accountable. I think we're probably moving in a better direction. I wasn't around, I wasn't in Treasury at the time the Reserve Bank Act was decided, but what was conscious in my mind there was sort of what we call now fiscal dominance, that I found when I got into Treasury, that an individual trading bank could tell the Reserve Bank how much money it needed to restore its cash position. And then it could also tell it what the interest rate would be. Well, it could only do that if it had Mr. Muldoon's approval. But he might give it for sort of fiscal reasons. So the board was set up to protect the governor from that sort of under the table. These are all private conversations. Parliament or even the Prime Minister's colleagues probably didn't know about the conversation. But now it's a different situation, and I think the moves to a more conventional board, which has greater sway over the governor, is right.
We're running out of time. We're standing between everybody and a drink, which is always a dangerous place to stand. To wrap up, and I would note we've sort of let fiscal policy off the hook a little bit through this discussion, not intentionally. We haven't focused too much in on fiscal policy, but this is an advice to the incoming government, the briefing to the minister. So just to quickly down the group, what would be your key bit of advice that we haven't talked about so far to the Minister of Finance in terms of getting out of this cycle and setting the bank up for the future? Do you want to start, Henry?
I think fiscal consolidation is probably the thing that I think is top of the list, and it's not necessarily, certainly support the Reserve Bank in meeting their objective, but there's certainly been an immense amount of fiscal stimulus over the past few years, and it's been a challenge to wind that back, but it's absolutely necessary when you look at the external position of New Zealand, and we're a small open economy vulnerable to shocks, and we need to be in a position to respond to those as they emerge.
Bryce?
Yeah, I'm a hawk. I think the 1% to 3% inflation rate is far too high. The 0 to 2% I thought was probably about right, because the Boskin report in the US in the early 70s concluded that CPI drift was about 0.7%, 0.8% per annum. So the midpoint of 0 to 2 is about price stability, and the central feature of the central biggest thing in the Reserve Bank Act was that the Reserve Bank was to achieve and then maintain stability in the general level of prices. the general level of prices. That should be a zero change in the CPI if properly measured. And we've had, you know, our currency is worth a fraction of what it was when that act was passed in 1988, was it? And what I thought it was grotesque that we had central banks around the world trying to get interest rates close to zero or negative to try and get inflation up into their 2% bracket, where, because of what was happening with globalization in China, traded goods prices weren't moving. The low inflation, as far as I could see, was benign. But here we had this perversity of central banks being under attack and trying to lift inflation. Well, we all know how hard it is to get inflation down once expectations have got up. Here we were sort of corrupting price stability by that.
Grant, your final word.
Well, I think
Advice
the best thing the government can do is to consolidate its fiscal position. It will assist monetary policy in achieving its objective in the short to medium term, and also from a long term get the fiscal ship back on an even keel. Because like in other countries, the fiscal position blew out over the past 6 years. Post-COVID, it has not been brought back, and that needs to happen. And that will also assist monetary policy.
It's pretty clear, unambiguous advice from our three panellists. Can I thank them very much for their session and their insights. Thank you for watching the panel. I think that's about to conclude the day. I think Mr. Bolger will be here to tell us how we can obtain an orange juice.